When you're dealing with different types of accounts that have different tax advantages, you have the 401k, like you mentioned, you get to put money in pre-tax there. That money grows tax deferred. So you have this embedded tax bill that you've got to pay at some point down the road. You also mentioned having money that is non-qualified, which means that it's just in a regular old investment account. It doesn't have any special tax privileges, and then you've got this money in the Roth. So when you have money in those different accounts, you want to look at the way that they're taxed, because you want to take a real tax efficient strategy toward managing money. Since we can assume, based on the current laws, that the money in the Roth has already been taxed and that it won't be taxed going forward. Now, that is assumption, that could change if Congress could garner enough support to change the laws of the Roth. But the way I like to approach it is to get your most aggressive pieces of your portfolio in your Roth. So all of the assets that you have in all of your investment accounts that are for the same purpose, let's just say retirement in this case, should be considered one portfolio strategy. So maybe you're following the 55 to 65 model. You want, and you're using the tracker. You want to put all of your assets, if possible, on the tracker, and that'll show you exactly where you need to be. Then, depending on which strategy you're following, if you're building your own portfolio with individual stocks, you're going to want to get the most aggressive stocks in your Roth account. So those are going to be things like technology, healthcare, maybe some companies in other areas like industrials, materials, and energy. If you're into buying the small and the small cap or the micro cap to kind of complement some of your portfolio to go for some higher growth, those are the things that you want to hold in your Roth.